We're still speaking to Tanya Tosen. She's the Tax and Remuneration Specialist at Tax Consulting SA. She's also a SARA accredited Master Mobility Specialist. We're looking at how the two-pot withdrawals have kind of prompted this vicious cycle of contribute, withdraw, tax, and repeat, rinse and repeat. I mean, you've summarized something that you describe as a fundamental flaw, that you cannot solve a cash flow problem with a retirement solution. But that is seemingly this is not an unintentional consequence. That is ultimately what they were trying to do from my standpoint. Were they not aware that this was ultimately a trend that would emerge?
I don't think people have been fully geared for it. And I think employers are feeling, they've done the responsible thing in forcing employees to save towards retirement. But they possibly do not have the ear on the ground to understand realistically what does that translate to. And the additional knock-on effect, which people aren't aware, is when you withdraw this money from your retirement fund, if you owe money to SARS, they're going to take their cut first. So there's been a lot of cases where employees get actually next to nothing because they have debts with SARS. Secondly, it's taxed at your marginal rate of tax. So if you are bordering another tax bracket, all your other income that you're earning from the company gets added to this withdrawal, and you could be possibly pushed into a higher tax bracket where if you wait till retirement, if that's your only source of income, that income gets taxed at a much lower marginal rate. So again, there's massive erosion with higher taxes potentially being paid on these withdrawals.
If people are generally feeling trapped, that will ultimately impact employers. Can you take us through how?
Yes, absolutely. If there isn't this open dialogue that employees can have with your executive team, this cycle is going to continue to repeat because they have no out. If you look at the stats, most employees are under severe pressure. All your households are under a lot of debt. So they're servicing debt. So they just don't have that cash flow. So this is the easiest way to top up their monthly cash salary. So you're just going to see people having a higher withdrawal behavior month on month, year on year, which is great for the fiscus. It's going to top up the pot for SARS. However, where there's no out, eventually that type of employee, especially if it's at a talent level, is going to start to look for other opportunities because there's no other option to get additional income. Companies are strained at the moment where, increased percentages are generally based on CPI, which is in the vicinity of 3-4%. But if you look at the trend of just basic items like medical aid, fuel prices, we know that is going up significantly. It's not that 3-4% inflation rate. So they've got nowhere to turn to, and the talent force in your organization may be severely impacted where they look for other opportunities to get a better package, where the cash is maximized and they have the flexibility in choosing how much retirement, how much they want to put towards risk benefits to maximize their take-home pay. Not because they might not like the organization, but they just can't make it in the real world with their current disposable income.
It's really concerning. I mean, you say at the end that the two-pot system is not the problem. It exposes the problem. Employees are not failing to save. They're struggling to make ends meet. So then how do we rethink remuneration?
So that's a fantastic question, and I really hope employers take this seriously. In the market in South Africa, the best way to attract and retain your talent force is to adopt a cost-to-company structure, but with flexibility included. So that then empowers employees to elect how much within certain parameters and governance standards. So you won't let employees opt out of saving from retirement, but they could possibly drop their benefit contributions every month and also look at certain risk benefits. Do all your employees need a maximum cover of, let's say, a 5 times debt cover or 3 times debt cover? How much disability cover? All these items add up to an employee's total cost. But if they don't value those benefits and you're forcing them, it's almost a grudge purchase, where if they have flexibility and they reduce that to the minimum requirements, that additional saving can be put to cash, which then inadvertently increases the net take-home pay. So it's a win-win, both for employers, because your cost to company remains the same, and then you're empowering those employees to actually design a package that works for them, especially in this economic climate.